Thursday, February 11th, 2021, Maneco 64, home of alternative economics and contrarian views. Today we're going to look at gold and silver during a deflationary collapse. And why a deflationary collapse? Well, because there's a lot of information out there on the internet, on the media, that gold would collapse, the price of gold and silver would collapse in a deflationary collapse. And I want to give my 2 cents, my opinion on that. And I think it's going to be completely different. I don't think the price of gold and silver will collapse. There is one guy out there, Harry Dent Jr., who was saying a year or two ago that gold was going to go back to 700. I see that now he's saying it's going to go back to 1,000. So he's getting a little higher on that. Yes, Harry Dent Jr., I'm not like equating him to his father or anything, but his father was an advisor to President Richard Nixon. So just have that in mind and look at what President Nixon did to the dollar by taking it off the pegging from gold by making it inconvertible, right? So, yes, and we have to remember that during the Great Depression, throughout the 1920s up until the early 1930s, gold and the dollar were the same thing. They were money. So when the Dow collapsed, yes, it collapsed in gold. Yes, the Dow gold ratio was the Dow. So the Dow collapsed. And what happened to gold? Well, gold was still at $20.67 an ounce. By 1933, the whole system had almost collapsed, the financial and banking system. There were runs on the banks. And when Roosevelt was inaugurated on March 4th, I think, 1933, he immediately declared a bank holiday. So for a week, people couldn't go to their bank to withdraw all the gold. And why were they withdrawing all the gold? Well, because throughout the 1920s and early 30s, the banks acted irresponsibly. They issued too many liabilities, too much credit, too many loans, and they didn't have enough assets or backing for those liabilities. Of course, that was gold. And I highly recommend, before I continue, that you read a book by Murray Rothbard from the Austrian School of Economics entitled America's Great Depression. It's a classic. I know there's a few other people like Friedman, and I forgot the name of the lady that wrote the book with him about the Great Depression. There's Bernanke, who also wrote a book about the Great Depression. But I think this is a really good perspective. It shows how Wall Street and the Federal Reserve inflated the system. And yes, we got a deflationary collapse. Did the price of gold go down in the 30s? Well, as I said, the price of gold didn't have a price of gold because gold was money. So what happened in 1933? Yeah, that bank holiday, because people wanted their money, and by money I mean their gold. So they're rushing to the bank to try to get their money. So Roosevelt had to stop that. There were massive bankruptcies, of course, in the Great Depression. There was what we call counterparty risk. With physical gold and silver, of course, you don't have counterparty risk. So, but if you had your gold in the bank, you wanted it out. And that's what happened, counterparty risk. What else happened? Well, gold was so out of favor, and I'm being sarcastic here, in the early 30s, that President Roosevelt had to sign an executive order to basically confiscate gold from America's Executive Order 6102 in 1933 as well. so out of favor that the government needed it desperately, right? So that's the other point there. And what about nowadays? Of course, gold is not used as money. Gold doesn't back the U.S. monetary system. The Federal Reserve and the U.S. Treasury, they can conjure up massive debts, as we've seen, out of thin air. It doesn't have to have gold backing. Back then it did, and that's why Roosevelt had to confiscate the gold and then revalue gold versus the liability of the banks, the paper dollar, from $20.75 an ounce to $35. So where was the price drop there, Mr. Dent? So nowadays, of course, there is no limit to how much they can print. The dollar is not interchangeable anymore as gold. Dollar is a paper liability, and they can keep inflating as much as they want. Yes, there will come a point where people lose confidence in the paper dollar, and they'll rush to anything but the paper dollar, and that, of course, includes golds and other tangible assets and things that hold their value. So we saw there's a worry now because I've seen some articles, people talking about in the FT, for example, yesterday, they're saying that the Fed might have to slow down their expansion of monetary policy because fiscal policy is going to be very strong, a lot of spending. But we also have been seeing that Fed presidents are saying, no, we're gonna let this run. We're gonna keep rates low, and even if they start unwinding, as they tried, as Jay Powell, and a little bit to some extent Janet Yellen towards the end of her chairwomanship, whatever you want to call it, did. We saw what happens. There is no way out anymore once you start on the path of inflation. And that's the other thing that makes people confused, and that it doesn't help people understand what inflation and deflation is. We've had inflation, of course. But as I said, they started raising rates, Jay Powell especially, unwinding the balance sheet. And look what happened in 2019. There was a repo crisis. The Federal Reserve had to bail out Wall Street again, wrote a blank check to save the repo market. And then we had the collapse last year in March. And yes, they've had to start all over again. They may try again in 3 or 4 years to unwind, but it's going to be a disaster. So yes, the other point I would look at is Japan, because we know Japan has had 3 lost decades. Japan has negative interest rates. It's been in a deflationary recession, depression for many decades, as I said, after the housing bubble it had and stock market bubble that topped in 1989. And you would think that the price of gold in Japanese yen had collapsed, right? But even though I only have a chart for the last 20 years or so, that's the price of gold in Japanese yen since the beginning of the century. So it was around 30,000 yen, and now it's almost up to 200,000 yen. So there's another example of gold in a deflationary environment. I think in the early 90s, if I'm not mistaken, it was around 60 or 70,000. Yes, it came down there, but gold came down in all currencies in the 90s, right? Most important thing in terms of having gold and silver in a deflationary collapse, if we're going to have one, and I'm not saying we're not going to have one, all I think is that it would be, in my opinion, unwise to get rid of one's physical gold and silver. Yes, I did an interview with Glint's CEO yesterday, and many of you said, oh, I thought you told us to stack, but you are stacking through Glint because your gold is held outside the system in a private vault in Switzerland. Yes, I prefer physical gold near me I do have a Glint account, but it's not where I hold most of my gold. And the only reason I like Glint is because I've known the people there for over 3 years, and their heart is in the philosophy of sound money and in the philosophy of protecting people's savings through gold. Yes, it has one foot in the system, so to speak, because you can take that gold out of the vault and exchange it for the local fiat currency and spend it. But it just gives people more option. It might not be your cup of tea, but it might be someone else's cup of tea. So we need to keep an open mind. But yes, as per counterparty risk, it's not only the government that will have counterparty risk, even though I think the counterparty risk for Uncle Sam is that his credit becomes less and less attractive. That means a lower paper dollar. But for the big banks, big corporations, yes, they could go bust again. And if you have your fiat dollars in the bank, that will be wiped out. No FDIC or FSCS insurance in the UK, for example, will ever cover your deposits in a systemic collapse. So, and not only that, but non-financial corporations, they will go bust in a deflationary collapse. The whole system, the whole economy is leveraged on credit. And yes, having physical gold outside the system will save you. You will have a way to survive. Just like people in the 30s had a way to survive if they had gold and silver savings. Yes, they confiscated the gold, but it's still not a reason to say that gold goes down in a deflationary collapse. Someone had a lot of jewelry and didn't have to hand that in. That would have helped a lot. And if you had, for example, and I'll finish with this point because that's another question that I get. What about the mining stocks? Well, how will they do in a deflationary collapse? Well, here's Homestake Mining. I think it was one of the biggest mining companies during that period. That's how it did from 1924 to 1936. The red line, of course, the red chart is the Dow Jones Industrial Average, and the green one is Homestake Mining. So as you can see there, it went to the moon, so to speak, back in the early 30s, mid 30s, while the Dow was languishing. So I'll stop at that. And now we'll look at the markets this morning. It is 8:39 a.m. London time. Yes, I think the bullion banks are desperate in terms of silver. We saw yesterday at around 12 o'clock London, midday, the price of silver just dumped. And why did it do that? Well, 12 o'clock is an important time for the silver market worldwide. It's when the bullion banks do their fixing. Fixing doesn't necessarily mean they manipulate the price. It's just that they take a reference price at that time. But I would say they probably manipulated it through the futures, and then on the LBMA market where they make the fixing, they were able to fix the price near 27, even though it was at right 27.40 a few minutes before. And what's that fixing price useful for? Well, that's a reference price for the next 24 hours until today, 12 o'clock, for refiners, for miners, for wholesalers. That's the price at which they transact real silver. And I think, yes, it's truly despicable that they do that, because we know the real price of silver is a lot higher. All they're doing here is hurting a lot of people, especially the miners, and they're helping the people that buy silver, of course, the big silver users. And that's what happened yesterday. I think they're still desperate. I think gold as well is consolidating before moving higher. And silver is only a matter of time. I think demand is still very strong for silver. So right now we've got spot gold at 1842. It's basically unchanged, down slightly. Range has been 1834 to 1846. Spot silver right now is at 2710. That's up about 10 cents. Low has been actually 26.69. That's yesterday the low was 80. So we've already had shenanigans overnight. I didn't see it. I was asleep. The Dow futures up 36. S&P futures up 5. NASDAQ is up 31. What about the fiat currencies? The pound's down slightly, 138.20. The euro is unchanged, 121.23. The dollar is unchanged versus the yen, 104.66. Dollar creeping or falling slowly but surely versus the yuan. We're back below 642. High-grade copper still strong. We're unchanged but still at high levels at 377. WTI crude is down 0.75% at 58.16. And just to finish off, let's look at where the 10-year yield is. 10-year yield is at 113, so that's down 2 basis points. So yes, the other day I think I saw that Jamie Dimon, the CEO of JP Morgan Chase Bank, who are they? Of course, we all know who JP Morgan is, but more importantly, they're the banker to the U.S. Treasury. JP Morgan executes all the trades for the Exchange Stabilization Fund, which was, by the way, created by FDR by the Gold Act of 1934. And why did they create that? Well, because the U.S. Treasury made billions from confiscating your grandparents' gold in the States. And then why did they make billions? Well, because they took it from you at $20.67 an ounce. And then less than a year later, they revalued it to 35. It was a great trade. And with that profit, they created the Exchange Stabilization Fund because they knew they were going to have to manipulate the markets because the markets were not based on sound money anymore, on the free market. So that's why Jamie Dimon was probably meeting Joe Biden. I would also imagine that Janet Yellen was close by, or even if she wasn't, she gave President Biden probably a lot of questions for Jamie Dimon. And yes, that's why he was there, trying to keep this bond market from imploding and from having interest rates go higher, because Uncle Sam cannot function if interest rates start creeping up, because that's gonna ruin the game, ruin the party of free money to buy votes, right? Or I guess nowadays you don't even have to buy votes, considering what's happened in the last election. So there you go. If you enjoyed this video, make sure you hit the like button. Make sure you share this video as well, far and wide. And make sure you subscribe to my channel if you haven't yet and you enjoy my videos. So and you can also follow me on Twitter, Facebook, and all these other platforms below here. I wish you all a great day. Take care. Bye.